Hello, and welcome to the Summit View from Glassy Mountain Advisors. I'm Jordan Smythe, the founder of Glassy Mountain Advisors, and in this condensed version of our quarterly commentary, I'm going to provide a brief overview of our thoughts on the third quarter of 2024 and our market outlook. You can find more details in the latest quarterly view on our blog. The S&P 500 index rose 5.9%, including dividends, during the third quarter, posting a 22.1% total return for the year to date. Returns broadened across various sectors, and technology stocks didn't dominate the market's performance as they did in the first half of the year, as investors began to scrutinize these companies' increased spending on artificial intelligence. Financials and industrials were the biggest contributors to S&P 500's quarterly returns. Utilities and real estate also outperformed the index. Small capitalization and international stocks returned to favor after a long period of dragging on portfolio performance. Declining inflation and rising unemployment spurred the Federal Reserve to lower the Fed funds target rate by a half percentage point at the September FOMC meeting. Accordingly, bond prices rose during the third quarter. With the probability of a recession remaining low, riskier and higher yielding corporate bonds have continued to outperform U.S. Treasuries during the year. The U.S. economy continued to expand, largely due to steady consumer spending. Retail sales remained positive this summer and increased by 0.4% from August to September. And consumer sentiment, as surveyed by the University of Michigan, was at a 5-month high of 70.1 in September. Earnings growth for S&P 500 companies in the second quarter, reported in the third quarter, came in at an 11.2% year-over-year rate, according to FactSet, the highest pace of growth in nearly 3 years. 80% of S&P 500 firms beat estimates for second quarter earnings. The latest employment report for September showed a more resilient labor market. Job creation bounced back, and the unemployment rate eased. Inflation dropped considerably throughout the summer, falling to a year-over-year rate of 2.5% in August, and after the Fed meeting to 2.4% in September. The rapid shift in consumer price growth showed that the Fed's aggressive rate tightening approach was having its intended effect. We are optimistic that positive stock returns will likely continue, despite anxiety about the upcoming election. Having started its rate-cutting cycle, the Fed will probably make 2 more quarter-point cuts by year-end, which would bring the Fed funds target range to 4.25% to 4.5%. These rate cuts should help the U.S. economy stay in expansion mode and avoid recession. Inflation is declining, which offers some relief to budget-stretched consumers and should help sustain spending. Corporate earnings strength should also help support ongoing economic growth and market returns. Although events like major hurricanes and the election may cause short-term reactions in stocks, we advise investors not to get too anxious about the effect of these events on the economy or the financial markets. In particular, history has proven that the outcome of past presidential elections has not significantly impacted long-term financial trends. When it comes to market performance, there are more important factors to consider, including economic fundamentals and the bottom-line performance of businesses. If you'd like more details on our views, go to our blog at GlassyMountainAdvisors.com for our October 2024 quarterly view. Thanks for joining us. Take care.